Hold your equity mutual funds for 1 year and you could pay significantly less tax. Want to keep more of your hard-earned investment gains? Understanding how they're taxed is the first step. The 1-year holding rule is your secret tax weapon, and we're here to explain exactly how it works with the latest updates. This is your quick tax update. Short, simple, and sweet. Let's break down the current tax rates. If you sell your equity mutual fund units within 12 months of buying them, those profits are treated as short-term capital gains or STCG for tax purposes. They're now taxed at a flat 20% rate. Yes, that's 20%, up from the old 15% rate. Remember this date, July 23, 2024, market. That's when the higher rates kicked in. For example, a short-term gain of $60,000 would now attract $12,000 in tax. But if you hold those same units for more than 12 months before selling, your profits become long-term capital gains, or LTCG, and are taxed at a much lower 12.5%. That rate was also raised from 10% last year, so it's crucial to update your mental tax calculator. But there's good news. The LTCG exemption limit also rose. It's now Rs 1.25 lakh for the financial year 2025-26. This means you only pay LTCG tax on total long-term gains above Rs 1.25 lakh in a financial year. Let's run a quick example. Say you make Rs 2 lakh in long-term gains. First, you subtract the Rs 1.25 lakh exemption. Your taxable LTCG becomes just Rs 75,000. At 12.5%, your tax is only Rs 2,375. That's much better than paying 20% on the full amount if you'd sold earlier. What about SIPs? The tax rules apply on a first-in, first-out basis. Each SIP installment has its own 12-month clock. When you sell, the oldest units are considered sold first. And be careful with switches, moving from a regular to a direct plan, or from a growth to a dividend option within the same fund, counts as a redemption. It's a taxable event. Always keep your account statements and realized gain reports handy for tax filing. For smart planning, try to time large redemptions to cross the 12-month mark. And consider spreading gains across different financial years to make the most of the annual Rs 1.25 lakh exemption. Also, remember you can set off capital losses against gains as per tax rules, and even carry forward losses for up to 8 years if you report them. The key takeaway is that while the tax rates have changed, the fundamental 12-month holding rule hasn't. So, to recap, STCG is 20%, LTCG is 12.5% on gains above Rs 1.25 lakh. Plan your exits wisely around that 1-year mark.